Hi there, welcome to a market call. It's great to have you here. We've got David Burrows of Barometer Capital Management. He's taking your questions on North American large caps. You can send your questions in to David by email, marketcall@bnnbloomberg.ca, or call him right now, 1-855-326-6266. David, great to have you here. Thanks for joining us.
Well, it's great to be here.
We're seeing a mixed showing for stocks today, but of course, markets near record levels. Do you think there's too much euphoria out there?
You know, we think actually the market's in a pretty good spot. We're into like the two toughest weeks of the year, but you always have to look at the state the market comes in on. And we've got close to 70% of stocks ahead of the S&P on the year, so we've got a nice broad-based market. We got a lot of sectors that are working. And really when you have to worry is when breadth is narrow and when there's a small number of companies contributing, and if they were to break, then you can get hurt. So there's a great opportunity right now for investors to be diversified in the U.S., in Canada, globally. So no, I don't think that there's too much euphoria. I think there's lots of people that are worried, which is good. But in general, we think that the signs are pretty good for the fourth quarter.
Did you say 70% of the stocks in the S&P 500 have beaten the index this year?
So at the beginning of the year, we had a highly concentrated market. In June, 24% of stocks were ahead of the S&P for the year, which is the lowest in about 30 years. Since then, the market has broadened. The equal weight index is outperforming the market cap weighted index, which tells you the average stock is beating the S&P. And 80% of companies are trading above their 200-day moving average. That's as good as it's been all year long. So if you want to look at the conditions underneath the market surface, and arguably there's some big stocks that are struggling, market in general is acting really well.
Internationally, you've been adding global exposure, Japan, India, Latin America, and even some China.
Yeah, we actually took one of our funds in December of last year and we converted it to a pure global mandate, MSCI ex-US, so nothing to do with the US, with a view that we have probably several years of global outperformance. I think that fund's up about 21% on the year. And in general, there's lots of markets that are performing well. The one outstanding market that was weak was China. And they really brought the bazooka out 2 weeks ago and made it clear. It was kind of like a 2009 moment. The PBOC said, look, we're going to put money in the market. If it's not enough, we'll put more money in the market. Fiscal policy, monetary policy. It may be their economy has some work to do, but the market, I think, probably has put in its lows.
Okay, we are looking forward to having David Burrows on the show today. David is President and Chief Investment Strategist at Barometer Capital Management. He's taking your questions on North American large caps. There's the number, 1-855-326-6266. Let's kick off here with an email from Patrick. Patrick is curious about CGI Group. Can I get Mr. Burrows' opinion?
Yeah, so Patrick, on CGI, this is a company that in general has relatively low organic growth, and they kind of rely on making acquisitions to grow. And they've been successful at it. Our choice in the group is to own Constellation Software. They have been able to spin out a whole bunch of the investments that they've made. And they've been very, very successful in their acquisition strategy as well. They're more or less similar strategies in different businesses, Constellation Software, CGI more in consulting. So we prefer the Constellation, but I think you're probably okay in CGI.
Okay. Randy has sent us an email. I'm wondering, is it a good time to buy Loblaws?
Yeah, so look, Loblaws has had a great year. Their exposure through shoppers has been really, really strong. Certainly it's not hurting being able to sell GLP-1 drugs, you know, and have them prescribed at the counter by the pharmacist. That's not such a bad thing. Anyway, I like Loblaws. We own it. I will point out that over the last couple of months, some of the defensive stocks have had a pretty good move with the view that fall can be sloppy, and so far fall has not been so sloppy. So it's up a bunch, but we like the stock and we will continue to hold it.
Right. Is that actually, can pharmacists actually...
In some cases, they can prescribe.
Oh, that's interesting. The GLP-1 drugs, the glucagon-like peptide 1. Yeah. Okay, I didn't even know it stood for that. Glucagon-like peptide 1. We have John in London, Ontario. Go ahead, please.
Andrew, I love the endocrinology. Thank you for that. David,
Thank you.
A year ago, just about a year ago, September last year, we wanted, as a family, to add to a consumer staples, consumer discretionary. So I bought Walmart, my wife Costco, my daughter Dollarama, and I'll tell you, all three have done well. But my daughter's Dollarama just keeps marching on. It seems impervious to interest rates, inflation, political unrest. Am I to add this to my portfolio? Thanks very much.
Thanks, John.
So, John, this has been a great one. This is in our top 10 positions in the firm. We've used it as a top pick over the last year. This is a company that continues to execute. You know, father-son team has been really, really strong. From a management perspective, it's a really well-managed business. They've still got lots of opportunity to grow. You know, we own Costco as well, and we like them both. You know, as I say, these more defensive companies have done very, very well, but I wouldn't want to bet against Dollarama.
Okay, so it's a good candidate for a long-term hold?
Yeah.
Keith is calling from Paris, Ontario. Keith, go ahead, please.
Hi, my question's on Brookfield Infrastructure. I own it in my TFSA. Can you put to rest, please, should I have BIP.UN and BIPC, which is the better one or which is the one to go with? I'm looking to consolidate. Thank you.
Okay, so one is the corporate, one is the partnership, I think, David.
Yeah. Well, I'm going to be a little bit more general than that. I'm not going to try and split hairs. The infrastructure stocks have had a good lift over the course of the last 3 months, as utilities have had a good lift. I prefer the infrastructure builders to the infrastructure owners right now. Lots of money being spent building infrastructure, and there's a little bit more leverage in the earnings. You know, the Brookfield has about a 3.6% dividend yield, but it's only growing at about 5 or 6%. I prefer a little bit more dividend growth. So we're looking at things, looking for dividend growth north of 10%. The bond market's had a pretty good bounce over the last year, bottomed about 12 months ago. Bond market's up about 10%. Dividend growth is up over 20%. So we're more focused there. We think that a lot of the move in the bond market's sort of been done, especially in the 10-year bond. And so if the 10-year bond sort of stabilizes in here, there's less push for high dividend paying stocks and maybe more attractive in dividend growth. But you're not going to get hurt. It just might be a little bit less than market performer. Okay,
Brookfield Infrastructure. When you say builders, is that engineering companies?
Yeah, like the engineering companies and the companies involved in infrastructure construction.
Sure, like a WSP.
WSP is a big holding of ours.
Oh, okay. Daryl is calling from Winnipeg. Go ahead, Daryl, please.
Hello. I'd like to get the guest's thoughts on using long-term moving averages before entering a position, like either the 100 or 150 or 200-day moving average. In the past, I've heard you talk about point and figure, which I don't understand well enough, so I'm wondering if there's another indicator that you would also look at, like an RSI or something. Thank you.
Thank you very much.
Sure. So certainly long-term moving averages are really important. I mean, it's a 200-day moving average or even a 150-day moving average is a great indicator of long-term trend. One, is it trading above it? But more importantly, is the moving average pointed higher or lower? You know, oftentimes when a stock comes off the bottom, it might rally up and through the 200-day moving average, but if it's headed lower, more often than not, it's going to wind up pulling back and bouncing along that 200-day moving average until it gets swung higher. So if you're looking for an extended move, I always want to know all of our positions are above the 200-day. I want to know the positioning of the 200-day as it's rising. And then we do watch how far stretched things get above the 200, because often if you get way above the 200-day moving average, it can get pulled back in. But it's a great sort of last line in the sand to use, either 150-day or 200-day. And in fact, if you look at the S&P or one of the big indices, you can tell you're in a structural bull market if it's trading above the 200-week moving average.
200-week, that's getting pretty, that's a year, I guess.
Typically, if you looked at the bull market of the 80s and 90s or the bull market since 2013 in the U.S., it has very consistently hit that 200-week in a really bad, tough market and bounced off it. And that tells you when you're more a structural bull market, long-term bull market.
But in general, when a stock goes below its 200-day
I think you want to be gone.
You want to be gone. That's interesting. Yeah. John is in Milford, Ontario, in beautiful Prince Edward County. Go ahead, John, please.
Good day, David. Good day, David and Andrew.
Hey.
I'd like your thoughts on Bank of Nova Scotia going forward. I've owned it for probably 25 years. It's doing very well right now. What's your thoughts going forward? Thank you very much.
Okay.
Thank you.
So at Barometer, 25% of our firm assets are in financial services companies of some sort or another. So that's a pretty big overweight for us, especially if you compare to the S&P. We don't own Scotia. I think Scotia is in the process of going through a turnaround. If you go back over the last 10 years, though, it hasn't done so well. Scotia is doing well. One of the things I always do if I'm looking at a stock is I say, well, what are the rest of the stocks in the group doing? And the truth is, actually, the rest of the stocks are doing actually a little better. So I think it's great that Scotia has made this turn. I'm hopeful that they can kind of get things going in the right direction. Our positions are Royal and Commerce and National Bank. Those are the three that we own. And I would probably still stick to those leaders and let Scotia do a little bit more work. It's basically a straight up move from $44. US dollars. And I think that maybe it's got a little bit of work to do.
Over the past year, it has lagged the bank group. Okay, Scotia's up about 21%, excluding dividend, and the bank group is up about 28%. That's over the past 12 months.
Yeah, so it's moved straight from $60 to $72. Maybe let it consolidate a little bit. But it's definitely looking a lot better than it was 6 months ago.
We're going to be back with David Burrows of Barometer Capital Management. David is taking your questions on North American large caps. 1-855-326-6266. Robert is calling from Markham, Ontario. Go ahead, Robert, please.
Thanks for taking my call.
Pleasure.
Calling today about McKesson. Is it a buy, hold, or sell? Thank you.
McKesson.
Well, I'll tell you, we owned it earlier in the year, and we got stopped out of it a little while ago on their report where they gapped lower. I'm a big believer. If you're in a good market, you only need 20 positions in a portfolio to be diversified. You don't want to look like the index. And if something isn't behaving the way that you would expect it to, given what you think maybe it's time to step aside and let things develop. There's probably something else to do if you're in a decent market. So McKesson really has broken down technically. It's trading well below 200-day moving average. Moving average is rolled over. And there's other stocks in that sector that are doing okay. Not exactly the same, but some of the devices companies like Intuitive Surgical or some of the pharma companies like Lilly, which is a holding for us. But McKesson, it's got work to do, and I probably wouldn't put money there today.
Okay. Robert, thanks for that question. Joe in Montreal, go ahead, please.
Thank you, Andy. I want to ask your guest about Bank of America. It's been sold by Mr. Buffett, for $7 billion this year. And what do you think about the company coming up in the next 2 or 3 years? Is it worth still holding on to it? Thank you.
Thank you.
So look, we're into an easing cycle. So U.S. central bank is easing rates. Other governments are easing rates. And when I look at the types of things that are working in the market, they're more early cycle companies than late cycle companies. So I think that investors are looking to the next economic cycle. Earnings estimates for the market next year have been pretty stable at a significantly higher level than where we are today. So we like financial services in general. Yes, Bank of America has been for sale by Berkshire. However, they've been raising cash for quite a while now, and there's some question as to why they're doing it. Are they doing it to prepare for transition and create firepower? Are they doing it because they really don't want to be in Bank of America? I like the banking group. Our top choice is JP Morgan, and it's one of our top 5 holdings. But I think you're going to be okay with Bank of America. I think market's okay, the sector's okay. You're getting, paid pretty well. You get some probably high single digit dividend growth. I'd stay there.
Tony's on the line from Calgary. Tony, go ahead, please.
Yeah, thanks, Andrew. I'd like to ask David about TC Energy. I'm sure he's aware the separation from the liquids to the gas. What do you think about that transaction? And today's kind of like the day that action's happening with TRAP. Thanks.
Yeah, yeah. So we actually bought it in the run-up to the group. We own AltaGas, we own some Pembina pipe, but we bought some of the TC. There's now going to have to be some settling out that the split has been done to see things where things stand. We hold it, and we hold the split, and we'll assess it as we go forward here.
The spin-off of that South Bow, yeah, that's right. And it goes ex the South Bow stock today, it looks like.
Generally, when there are spin-outs, the spin-out is set up for success. So we really often like the product that comes out as the spin-out because very often at the beginning there'll be a bunch of people who don't know it and sell it off, and that can create an opportunity.
Right, and South Bow, SOBO, trading at around $29 right now. And Nizar is calling from Scarborough. Go ahead, Nizar, please.
Hi, Andy. Hi, David. May I have your thoughts on Manulife Financial, please? It is trading close to $40. If you permit me to use your phrase, does Manulife Financial qualify as a good, getting better stock? Is it a buy here? Thanks for taking my call.
Thanks, Nizar.
That's a great question. Yes, this qualifies as good, getting better. In the financials group, our biggest weight is in insurance. The number 1 firm position is Fairfax Financial in property and casualty and has been for some time. But Manulife is a significant position as well in the Canadian market. We also have some Intact. Look, this group is really behaving well. Ultimately, you're buying a giant investment portfolio. We think capital markets are pretty good. Their exposure in Asia, I think, is attractive. This is a company that we hold in most accounts.
Okay. When we come back, we'll take a look at David's past picks. You're watching Market Call. David was on our show February 27th of last year. His first idea was JP Morgan Chase. This stock up pretty nicely, a return of more than 50%. You'd stick with this one, David?
Here's the interesting thing about JP Morgan. If you look at the banking group in the U.S., it rolled over in 2007-8, and it didn't make a new high, the sector, until 2021.
Wow.
JP Morgan made a new all-time high in 2013. Right? That tells you something, right? Best managed, strongest balance sheet, spend by far the most on technology. They are the dominant player. And so if you're going to buy a sector, you buy the best company you can find first. And then if it continues to do well, you may add to the sector as you go. And JP Morgan definitely qualifies as that position. I'd buy it today.
Okay. Stantec, the engineering firm, and you've said you're interested in companies that will be involved in the infrastructure build-out. Not a bad return, though, almost 40%.
Yeah, these companies just continue to chuck along. WSP, we think, also is a great company. I'd buy it here. I considered using it as a top pick today. Lots of spending to be done. What's interesting about WSP, just as an aside, is that they have a very significant position in this acquisition they've made in U.S. power consulting. They'll be the largest in the U.S. in power consulting. So there's a lot of money going to get spent on the grid over the next number of years to fuel AI and electric vehicles and so on. So I would prefer WSP over Stantec today, but that group looks really strong.
And then ATS, they help companies to automate their manufacturing process. It has slipped over the past year.
Yeah, this one didn't work. The reason I use point and figure price charts is that it shows an orderly price pattern and takes out a lot of noise. I want to see every position we own make higher highs and higher lows, and that's an uptrend. And when the behavior changes, something's changing. And this one rolled over last summer. We got stopped out in August at $56. That's the value of a stop loss. It's a lot lower than that today. And the truth is, if you buy 20 stocks, 2 or 3 work way better than you thought, 7 or 8 are pretty good, and a bunch don't work. You just got to carve out the ones that don't work quickly before they hurt you.
I think one reason ATS is down is disappointing growth in electric vehicle equipment.
Yeah, they were having some good success with that, and that has been an issue for them.
Right. Okay. We're going to be back with David Burrows. He's president and chief investment strategist at Barometer Capital, and he's taking your questions on North America large caps. Okay, welcome back. Let's head to Sarnia, Ontario. Colin, go ahead, please.
Yeah, good afternoon, gentlemen.
Hi there.
Thank you for taking my question. I was going to ask a much more radioactive question, but I guess I'll have to wait for that one. My question is about BCE. I'm kind of looking to buy it around this level, hold it for 3 or 4 quarters to get a little boost from the higher dividend. What do you think of it at this time for that time period?
Thanks, Colin.
So, Colin, I think we always have to be very critical of the positions we're considering investing in. As I mentioned earlier, you only need 20 positions. BCE, sadly, is making a new relative strength low today against the rest of the market. Stock is trading below long-term moving averages. And think about the business, they're selling the family jewels to support the rest of the business, selling their position in MLSE. They're getting paid well for it, but it's a great investment. Is one that I'm be a little cautious on. I just think that there's much better places to be. You're going to get paid a dividend, but this is about getting a total return. And if the share price is going down and you're getting a dividend and the dividend isn't going to grow much, they're supporting the dividend, I think, by selling the MLSE. I would prefer to steer clear.
Okay. BCE, the parent of BNN Bloomberg through its ownership of CTV. Nicole is in Montreal. Go ahead, Nicole, please.
Happy day, guys. And David, I wish you were on the show more often. I think you're just fantastic. And thank you for mentioning Howmet Aerospace. I just wanted to know, looking forward to your thoughts on this company. Thanks. Have a great rest of the day.
Great.
Howmet Aerospace.
So Howmet Aerospace makes precision parts for jet engines, and they make fastening systems for planes. They are in, obviously, the defense market. Which is not a bad market to be in right now, and also jet engines. In jet engines, the next generation of engines have been somewhat delayed, and as a result, those that are selling parts are doing very well, and Howmet is one of them. This stock is up close to 2.5 times in the last 12 months, and it has gapped higher on literally every quarterly earnings report in the last year. They continually are beating estimates. This is a top 10 position at Barometer. And again, I thought about using it today, but I've used it before. I think it's making a new absolute and relative high versus the market. The defense sector is performing very well. There's obvious global geopolitical risks out there. We like the jet business. General Dynamics is performing really well as also. So I'd continue to buy the stock.
And Howmet has the symbol HWM. And as you say, it's up about 120%. I'm showing in the past 12 months, and it sure looks like it's trading at or near, certainly 52-week high. And just bear with me for a sec. I think it is trading at a record high. So that's interesting because they sell parts and people are having to hang on to older aircraft longer, David, is it?
Yes, but they also have very specialized components. And if you look at the stock chart, you'd see it is the archetypal stair step higher. You know, rallying, consolidating, rallying, consolidating, rallying, consolidating in a very tight range. It's obviously lots of buyers underneath the surface.
Okay, yeah, the stock is trading at record highs today. Okay, Moaz from Vancouver, go ahead, please.
Good morning, gentlemen. Thank you for taking my call.
Pleasure.
My question to David is about Eaton Corp, and I would like his recommendation in that space, either Eaton or American Tower or GE Veroneva.
Yeah,
thank you.
So Eaton Corp is a major supplier into the U.S. utilities, and they do power management systems. They sell transformers, although it's tough to buy one for the next 3 years because they're sold out. Eaton is selling the things that they need to build power capacity. They're also selling control systems if you're building an automated facility, but there's some reshoring of manufacturing in the U.S. I think that the future is very good for Eaton Corp. We like, as I mentioned earlier, you know, infrastructure around building the power grid, and this is a company that just continues to grow double digits.
Robert is calling from Smithville, Ontario. Go ahead, please.
Good afternoon, David and Andy, and thanks for taking my call.
Pleasure.
My question is on the TD Bank. I'd just like to get your take on it, taking into consideration the new CEO coming in, the failed acquisitions they've tried, money laundering, and everything else that's been going on with them. Presently, the stock hasn't really done much. I'd just like to know what your take is on it in maybe the next 12-month period.
Sure. So TD's had a great bounce off the lows. Mm-hmm. But then if you looked at the ZEB, which is the ETF, the equally weighted bank ETF, you know, it's also had a giant move. When there's change like this, the first few quarters can be a little bit bumpy. You know, often a new CEO will come in and find some things that they don't love, and as they call it, you know, throw at the kitchen sink, you know, in the first couple of quarters to make sure they get all the messes cleaned up. So this probably has that in front of it. Again, I'd prefer to stay in the cleaner stories in RBC or Commerce or National to TD. The group is doing well, and there's going to be good support from the group. And I'm not saying it's a bad bank. I'm just saying I can't own them all, and I prefer the other three.
Okay, Frank in Mississauga, Ontario. Go ahead, please.
Thanks, Andy, for taking my call.
Pleasure.
My question is for Couche-Tard. This has been a long-term winner for, you know, one of the success stories in the Canadian market. Lately, it's down because of the fears that it may have to raise equity because of the, you know, they're trying to buy the Japanese company. What do you think? Is it good to take a position at the moment, or we should wait for this to be cleared out?
Yeah. Well, I'll tell you what we're thinking. We did own the stock over the last 18 months. We came out of it because my analyst Brian McNichol, who's an excellent Canadian portfolio manager, came to us and said, "I think that the growth is slowing," and so we thought there was other things to do. Now, the opportunity that they have with 7-Eleven, far from clear as to whether they will be successful. You know, the offer was rejected. If they were to be successful, we would have to take a pretty hard look at maybe re-entering. But at this point, and I actually talked about it this morning, you know, it made a lower high in the end of the summer versus the earlier part of the summer. It's now making a lower low. You can see it there on the chart. So that's not our chart. That, to me, is a change in the behavior of the stock. And until something happens to put the technical situation right, or we see some reacceleration in growth, I would not add the position. But as I say, if they were to get that deal done, that would probably give them a runway of several years of growth and opportunity for synergies. But we'll wait and see.
We're going to be back with David Burrows of Barometer Capital Management. North American large caps are on the menu. We have an email from Scott. This stock has come up before. Can I get David's opinion on WSP? Now, you said you like this engineering company.
Yeah, we really like this company. They've made really good acquisitions along the way. They will be integrating a recent acquisition in the U.S., which is in power consulting. This puts them in a great position to grow in a growing market. The technical setup for the stock, I think, is very good. It had an opportunity to consolidate between 2001 and 2023 and has come out of that favorably. And so I think that this is sort of what we were talking about earlier, you know, owning a winning company in a sector that's got a tailwind. And the growth in power demand is coming at us, and I think that there's going to be lots of opportunities for them to do business.
We have an email from Henry. What's your long-term outlook on AT&T?
Well, the long-term outlook is hard to say. The reason the stock, I think, is doing so well is they've been putting the two satellite companies together, and ultimately that's going to create some value. We have looked at the stock. We own a little bit of the stock, but it's run from about $16 to $22 in a pretty short period of time. A lot of the excitement is around this merger of the satellite companies.
So you're not overly enthusiastic about it, David?
No.
Okay. We have Ron on the line from Calgary. He wants to ask, I believe, about a uranium explorer. Ron, go ahead.
Yes, hi. Thanks for taking my call.
Pleasure.
I would like to know, you were talking a couple months ago about owning a half position of NextGen.
Yeah.
And I'm wondering if you still hold it or not.
Thank you.
So, Ron, we came out of NextGen because when they raised money in the market and turned around and bought uranium with that money, we thought that was sort of at odds with the ultimate shareholder's best interest, which is probably working at building out the company. So it may well work out in their favor, but we just thought it was sort of off strategy, and so we stepped aside from the stock. If I had to buy one today, I'd probably buy Cameco, and I'm not saying that NextGen doesn't have a great asset. They do, but that was a concern to us, and obviously was a concern to some other people. Stocks sold off, after that news. So the uranium stocks have done much better over the last, month. It looks like they're kind of waking up. It's not in a vacuum. The commodities markets have been waking up in general prior to China making a turn, I think probably on the monetary easing. And so I think that cohort probably has a tailwind, but I would probably pick Cameco as the leader in the group.
We have Jacob on the line from Toronto. Go ahead, Jacob, please.
Yes, good afternoon, gentlemen. I'd like to ask your guest about Celestica, if it's time to buy it or what else to do. Thank you very much.
Thank you.
Yeah, it's tricky, so I'm going to put Celestica in the tech group, even though it's electronic contract manufacturing. We did own it over the past 18 months. We came out of it. You can see, again, this chart looks a lot like the Couche-Tard chart. It broke trend, it rallied, made a lower high, and is now making a lower low. In general, we have a very low weight in tech, which is probably unusual. Over the last 6 months, we took our weight down to about 12%, and have been that way for about the last 4 months. So that's versus about 28 or 29 in the S&P. It's only because there are so many other things to do that are less crowded than tech that we have a lower weight right now. So right now, I don't think the technical setup is great. I don't think that the backdrop for tech is as good as it was. And so we've been looking at ideas in other sectors.
Okay, we have Kane on the line from Montreal. Go ahead, please.
Ken from Markham.
Kane from Markham.
Oh, I'm sorry about that, Kane. Go ahead. What's your question, please?
That's okay. Thank you for this opportunity.
Thank you.
My question on Disney, DIS. I'm holding this stock for almost a couple of years, and it has almost dropped 30% from my purchase price. My question is it worth holding it, or should I sell and get out with the loss?
Thank you.
So there's a few things going on here. One of them was that the streaming business, has been less exciting than people had hoped, or maybe people got too excited by the rumor, sell the news. But that being said, again, this is a stock that's wandering around in no man's land. Technically, there isn't a great reason to buy it unless you're a bottom picker, and we are not bottom pickers. That's a dangerous game. So I think that I would let the situation start to improve before I would put money to work there.
It's not calling to you. Okay. Roy in Pincher Creek, Alberta. Go ahead, please.
Hey, how you doing today?
Very good, and thanks for calling.
I was wondering about Cenovus stock.
Yep, Cenovus.
And wondering, okay, I bought it when it was really low, right? And it went up to, I seen it up to $25. Is it going to go any higher, or should I get out?
Thank you.
Great question. Okay, so let's talk about energy for a moment. Oil prices have been weak recently. We know that. We got a lot of conflict going on in the Middle East. Saudi is saying they're going to supply the market, willing to go below the price deck. So there's obviously been concerns in energy. U.S. energy producers in general have performed much worse than Canadian producers, partly because the shale oil debate is, can they sustain production? The Canadian producers are not in that situation. So we own Suncor and we own Imperial Oil and we have some CNQ. And we think that longer term, the sector is an attractive sector and that these companies are going to generate a ton of cash. I think you could put Cenovus in the same category. But there's some near-term technical questions in the market. I'd love to see the price of oil start to stabilize. It's up over the last couple of days, but that's more geopolitically driven. But these companies, I think, are going to be huge cash flow generators. They're going to generate really strong dividend growth over the next 5 years. And so I would give these some space. They aren't technically broken in any way. They aren't leading the market right now. But, we're coming into winter, and generally they get a little firmer coming into winter. So I would be comfortable owning that company.
Cenovus, along with other oil sands stocks. Okay. Dominic is on the line from Montreal. Go ahead, please.
Yes, hello, Andy and David. Thanks for taking my call.
Pleasure.
I'm calling about Boeing. David, I know it's not trending higher, and it's not in your niche of stocks as it's moving, but because demand for aircraft is high and there's only two suppliers to meet this demand, would you consider it a good investment? If not at this price, what price would make it a good turnaround investment for you?
Yeah. So we own GE Aerospace, is a good-sized holding, and that's obviously jet engines purely now, right after the spinoff, and turbines. So we do own Embraer, ERJ, trading in New York. They have an opportunity to win some significant market share. They have possibility of bringing bigger planes. They're known for their regional jets.
Yes.
I would prefer not to step in front of Boeing. It's just not what we do. It's kind of like picking up dimes in front of a bulldozer. It can work and it can turn around and you can be a hero. I'd rather buy it 20% off the lows with a better technical setup because there's other things that are working right now. And you have to really look at your holdings and say, would I buy this today? And do I think it has a better shot than so many other companies? And I just don't think Boeing does. There's too many unhappy shareholders just waiting for it to move higher so they can get their money back.
You're right.
Right?
Yeah,
so you got all these built-in sellers. You don't need to fight your way through that. You want happy stakeholders around you.
Such a tragedy, a great American
It
company
really is.
mismanaged like that. Okay, we're out of time for calls. We're going to get David's top picks coming up next. First idea, BWX Technologies. What do they do, David?
So this is a company people may not know, but they've been running and building small nuclear reactors for the U.S. Navy since 1958. So they're pretty good at this stuff. 75% of their revenue comes from the U.S. government, very stable supply and service businesses. However, they've been building them for a long time, and there is a big demand for nuclear power, and they are working through the commercialization process. They do a lot of work with Ontario Power Generation currently, and so we think that this is a company that can open to the commercial market. It went sideways for about 5 years. It started moving higher about a year ago. We've owned it for about 10 or 12 months. It just broke out to new highs recently. Stock is delivering. There's a big market opportunity. Clearly, the hyperscalers need energy. You saw Microsoft's purchase of 3 Mile Island. This is going to be a company, I think, that really will be a leader in small modular nuclear reactors over the next 5 years and 10 years.
Apparently, in the Cold War, the Americans did research a nuclear-powered bomber. But after a while, they just gave up on it. Eisenhower apparently cancelled it, and then Kennedy restarted it. But in any case, it was not. I don't know. One of the designs would have just sprinkled nuclear waste over the landscape. In any case, Tech Resources is your next idea.
Yeah, look, great Canadian company, but selling to the world. We know that there is a lot of demand coming for power. We know there is only so much copper being produced. Chile, which produces 30% of the world's copper. Their production's at 2012 levels. There's very little new capacity coming on. Tech Resources started operating their CB2 mine a year ago. They are operating, on track. There's room to grow capacity. I like to own companies that are generating cash and will pay the shareholders over time. And so we think that this company can appreciate. We think that over the next 5 years, the earnings can double. I think copper prices are likely to be firm. The dividend could be significant over 5 years, and the multiple can double as investors come back to this sector. We think there's a good opportunity.
Right. The stock, so about 71. It looks like it's closing in on its May record of about 73 and change. Yeah.
The interesting thing is about this stock is that in the last commodity cycle, it was a multi-bagger.
Yes.
And that's what you would expect out of a commodity cycle. And we're now into an easing cycle, monetary policy. So this is where these stocks should start to behave better.
And finally, Uber Technologies. Where do you see the upside here, David?
So look, for those that are looking for a secular grower, right, one that is going to grow whether the economy's good or not, Uber fits right into that category. I happen to really like the technical setup because it's got a big base on it that's built over the last 10 or 12 months. And when we look at the opportunity that they have, they're operating on a quickly growing run rate. Their advertising, in-app advertising, is closing in on $1 billion revenue line. They have an opportunity coming at them in autonomous vehicles and alternate, types of delivery. And this is a company that's going to grow its cash flow and earnings significantly over the next 2, 3, and 5 years.
And of course, they have the whole delivery thing. And as you say, it's amazing. Communities such as Phoenix in America are on the verge of having robot taxis driving around.
Yeah. This is coming one way or another. And it's not going to stop at taxis. You look at the eVTOL market for passenger drones.
Oh, yeah.
That's coming sooner than people think. I think that they're looking at launching service in New York to Kennedy Airport, not too far away. And I think people get there in about 8 minutes for about $200, right? So there's all kinds of opportunity for them to expand markets, and they obviously market share leader. If you look at their competitors, look at Dish. Dish sets up pretty well also, but it's obviously just in the food delivery business. So we think that this is one that is probably one you want to own over the next several years.
Okay, I'm getting a bit confused there. Dish is...
Sorry, DoorDash.
DoorDash. Okay, yeah.
DoorDash.
I think you had satellites on your mind.
Sorry, DoorDash.
DoorDash, yeah, that's interesting. Do you order food? I never do because I'm too stingy.
I have 3 mid-20-year-old daughters.
Oh, forget it.
So they taught me a long time ago. I like to cook, frankly, but no... Uber would be one of what I would call one of my largest utilities on my statement every month.
I'm just too. I don't mind going out and picking up the food because I want to get out, and I just feel it's going to be cold by the time it gets there. But anyway, it's obviously very popular with people.
That's right.
Judging by the number of delivery drivers. And I wish they'd get lights for their electric bikes. Anyway, there's my public service announcement. David, thank you very much indeed.
Andy, thanks for having me.
We are out of time on a market call. We've got Cold Catcher coming up tomorrow. Thanks very much for watching our show.